Well, hey everybody, and welcome to my world. Welcome to the Animal Donut Channel. My name is Jeff Luke. I'm a professional photographer and the author of a few books about investing. And today I am going to help you see why some of your stocks are getting crushed. I'm going to teach you a few things, and something among them is going to help you. So by the time we get to the end of this video, you're going to understand some things about investing that you don't know right now. And something among those things is going to make you a much better investor. I can just feel it. So get out a piece of paper and a pen, or if you like to write things on your tablet or your iPad, or just type away on your phone, have something handy, because there will be a few take-homes here. I guarantee you, a few details, but they're going to be powerful ones that you'll always be able to use in your toolkit whenever you're thinking about investing in a stock. Okay? So the first thing I want to show you is this fence. Take a look at it. And this is symbolic, because everything within the confines of this circle, these are the things we're capable of understanding. And it only works if you know the value of things. Because if you just look at the stock price and you chase that around, you'll be like all the other investors on Robinhood or out in the brokerage world, looking at stock prices and charts and trying to figure out where the stock price is going. That's a really short-term, short-sighted, short-run way of looking, in my view, if you're just looking at stock prices and trying to guess where they're going. Instead, you want to compare the value of what you're getting over here with the price of what you're paying. When the price is way too high, when it's really high up here and the value is low, that's when you wind up finding yourself in these bubble territories where you're paying way too much for something. And then when prices readjust, like they did in January of 2022, you see the prices start to come down. They come down closer to what the true value is. But when stock markets are hot and everybody's excited, you get these valuations where the price is way up here and the value may be just down here, and things are now equalizing. So anyways, keeping this fence in mind, I am going to teach you everything I know about valuation in this video so that we can stay in here and talk about things we are capable of grasping. All right, so I'm going to show you 3 things that are going to help you get a good grasp about valuation using things in the real world, realistic items that I can show you, and this is going to help you grasp what we're talking about. So the first is this. It's a bottle of water. And if I were to ask you, what is a bottle of water worth? What's the first thing that comes to mind? My guess is somewhere between like 50 cents and maybe $1.50, $2. Why? I mean, why do you say that? Well, because you know what water's worth. I mean, it's good to have, it's got some value, but if somebody said, hey, I'll sell you a bottle of water for $20, you'd say, are you crazy? Because we all have some kind of a idea, a baseline in our mind for what this is worth, okay? Now I'm gonna show you something else that's a little different. Art is different, okay? Because when you think of something like this, now this is beautiful balloon dog, indigo dog, what's it worth? Well, it's probably worth more than $1, all right? And it's worth more than $5 or $10. But how much is it worth? Well, somebody might be willing to pay $500 for this dog right here. It all comes down to what somebody is willing to pay you in the open free market, in an auction or in person, and that is what an item like this is worth, what somebody will pay you for it. Question we need to ask is, well, why is it worth what someone will pay you for? And this is a great question. It's because the item itself, whether it's a bottle of water or that indigo dog, doesn't generate any value during its entire lifetime, except for like when you drink the water and it quenches your thirst, or you look at the dog. But neither of these things is actually generating dollars of free cash flow, of profits. Let me show you one more thing here. I used to collect baseball cards and basketball cards back when I was a kid, and I bought this one basketball card. This was in like 1981, I think, and this is Larry Bird's rookie card, and it's also Magic Johnson. There's Larry Bird, and there's Magic, and this is a card that I got, you know, in a pack that cost me about 25 cents. Now, what's this worth? Well, it's just a piece of paper. If you look at it, there's a plastic holder, and it's got a piece of paper inside. And that piece of paper between now and the end of time will never generate anything. It's never gonna give money, it's never gonna produce dollars or wealth or anything like that. Yet, there's a value to this. If you were to go onto eBay or something and type in Larry Bird, Magic Johnson rookie, you'd find out that this is worth something. Well, what's it worth? It's worth whatever somebody else will pay you. And that is a very interesting concept, because when we invest in stocks, we're not investing in collectibles like a baseball or a basketball card, and we're not investing in art like that indigo dog, and we're not investing in water. We're investing in a stock. And a stock is actually a legal part of ownership of a business. So when you buy stock in, say, Nvidia, you actually become a part owner in the Nvidia corporation. And when you buy stock in Apple, you become a part owner in Apple. Same for Amazon or Microsoft or Adobe or whatever. So why does this matter? Well, all of these companies, if they're profitable, generate income, which is profits, every quarter, every year. Well, they don't generate profits every quarter, but in general, profitable companies do generate money every year, and you get to keep some of that as a shareholder or as somebody who owns stock. That's a huge difference. Think of that. These collectibles or these commodities that I just showed you, which will remain what they are and never generate anything into the future, and then stock. So the next thing to think about is, well, how do you value stock? Well, this is a challenge. This is what makes investing so hard to do and takes so much time and study, but also makes it a challenge, like a game, is that you need to figure out this company. How is it going to generate money? And there are a few different questions. First of all, how much money is it going to generate, right? Then the other question is, when is it going to give you this money? You know, some companies earn a small amount now, but it looks like they're going to generate a lot more in the future. So you have to kind of consider all these things. And then what will the rate of growth of that company be over the next 1 year, over the next 5 or 10 years? So as you can see, there are a lot of moving parts. And that's what makes this idea of valuing a company or valuation so important. So what you want to do, if you can kind of focus your mind on this, is you want to get more in exchange of, in terms of value, than you pay. So you want to get value like way up here, and if you can, you want to pay a low price. Now, to answer the question at the beginning of this video, why are your stocks maybe getting crushed? It's because a lot of people were paying way up here for their stocks, but the value was actually kind of low. Meaning they were maybe saying, if we use the water analogy, here's the bottle of water, and they were paying 10 or 15 bucks for that bottle. And what's happening is now the prices for some of those fast growing stocks, it's coming back down, getting closer to value. So what you need to keep in mind is that price and value, sometimes they're kind of in sync. So what you pay and what you get, they kind of relate, but they become detached sometimes. And you need to be careful when prices get way too high compared to the value of what you get. And what you want to look out for and be patient for is when the price has come down but the value is high. And a lot of times in these situations, most investors get scared because they look and they see the low prices and they say, oh my gosh, that price is going to keep going down. I don't want it to keep going down. They forget this is a low price and the value could be way up here. So if you grasp this right now, you'll understand something fundamental, that all those investors just looking at price charts and stock prices and just squiggly lines all day long, they're just going up and down and up, they don't grasp this whole idea of valuation. Is there an easy way to learn how to value a company? Well, no, it's not easy. But why should it be easy to do something really well, that if you can do it just 1 or 2 or 3 times in your life can make you really rich? I mean, think about it. Why should that be easy? It's not. But with study and with patience, you can get there. So that's what I'm sharing with you right now, is this mindset. And I think understanding that price is what you pay, but value is what you get. And remember, price and value are really 2 distinct things. They align sometimes, but they get detached at other times. And what we've seen in the first month or so, first couple months of 2022, is that the prices were real high and the prices are coming down. We don't know whether the prices are really cheap now or they're going to keep going down. But as an investor, you're always comparing things. You're comparing the price of an asset to the value you get. So we've looked at a few things: the water bottle, the indigo dog, and the basketball card. And those things all have a value to them, but they do not generate any kind of cash. The asset itself does not generate any money, no matter how long we hold it or how much we want it to. Stocks are different. And what I'd like to do now is look at a stock, and we can now apply this idea of price and value to a stock and get an idea of how we might want to think about investing. So the stock we'd like to take a look at here is Airbnb. And you guys probably already know about the company. If you don't, it's vacation rentals. People who have a place to stay, like an apartment or a house, can rent it out for a day or a week or a month or whatever. And then people who need a place to stay when they're traveling can go on the app and reserve it and book it and do it all on the phone. And you know, it's a really great service. I think it's an incredible company, and I believe that the future is really bright for Airbnb. But I did not buy the stock. Have not bought it yet. Thinking about it, but there's a problem, and that is the value of the company right now. I don't think it's really high. I think the value is kind of low. And you might say, well, why? Like, how can you even say that? Well, here's what I base this on. The company is not yet profitable, okay? In 2019, the company lost money. These are in the financial statements that are available publicly. You can find this stuff online. And then in 2020, for obvious reasons with the pandemic, it lost a lot of money because people weren't traveling and they weren't booking places to stay. And the company has a lot of overhead and expenses just to run the company. So developers are a big part of it. So they have a lot of people working on the website and developing the codes and the algorithms and everything that the company needs. So the company lost money in 2020, and I wouldn't be surprised if when the financial results for 2021 come out, they may have lost money again. So when we go to pay a stock price, the stock price seems high to me in exchange or related to the value, which is the profitability of the company. So I would say that right now we're in a situation where the price is pretty high and the value is kind of low. For me as an investor, I like to stay away from these situations. In fact, Airbnb is not yet profitable, so I personally wouldn't invest in it. I would wait until a company like that became profitable, started generating money and income in the positive, and only then would I consider that as an investment. Otherwise, I think it's kind of speculative. I'm not saying you can't invest in things like that, but personally, if I did, I would do it in a separate account that I earmarked for intelligent speculations. These are riskier things, but I wouldn't do it as part of my investing, because when I look at investing for the long run, I want to invest in companies that are already profitable. So one thing about Airbnb is that the market cap of the company, which is the number of shares outstanding times the share price, is $107.8 billion. That's of today, February 14th, 2022. That's a very high valuation, more than $100 billion for a company that doesn't make money yet. And so the way that I look at these things is price is what you pay, value is what you get. You want to switch it so that you're paying a low price and you're getting a lot of value. That is the lesson in this video. And right now with Airbnb, I see it this way. And what's happened is a lot of stocks for companies that have been really high in 2021 and the beginning of 22, they're coming down. The valuation's not necessarily going up, the value of the company, but the prices have come down because investors are realizing, like, that was too expensive. That was way up here, and they're coming down. Whether we've reached fair value for some companies or all remains to be seen. Prices could continue to go down for days, weeks, months. We don't really know. That's one of the things that makes investing such a challenge. But you now know everything I believe you need to know, at least to get a beginning understanding. And the key takeaway here is price is what you pay, but value is what you get. And when we look at Airbnb, I'm gonna show you a graphic here. You can see the top line, which is the black line, is the share price. And below that, there's a red line, and that is what Morningstar, who created this graph, estimates the value to be. And so you have the price up here and the value here. And intelligent investors, in my view, aim to pay a price that's closer to the value, or if you really do well, you're able to pay a price that's far below the intrinsic value of what you're purchasing in the stock. But right now, as you can see in the graphic, the price is quite high compared to the value of the underlying company. And in my own view, I agree with that. It seems like until Airbnb is profitable, it's very hard to put a price tag on the shares of that stock that seem rational and grounded in any kind of sensible valuation of the company and the stock. So I hope that this is really useful to you. This is a toolkit you can use. It's just a mindset that you can carry with you. Whenever you're thinking about investment, always consider, what am I paying for the price and what is the value of what I'm getting? And you'll see when you start looking at other online articles, YouTube channels, whatever, and you see people talking about the prices, you'll see a lot of times people are talking about the price and it's not in relation to anything. It's not grounded in the cash that's generated, the profits of the company. It's just kind of trying to see where the stock price will go next, but it's separate entirely from the profitability of the company. And that's something, when you can start looking at what a company's worth and whether it's generating profits, that will make you a different kind of investor than people who only look at price. So keep this in mind. Price is one thing, value is another, and whenever possible, you want to pay a low price in comparison with a high amount of value. But you want to steer clear of situations where the price is real high and the value is low. I hope this is useful to you. If you like this video, please remember to hit the like button and also consider subscribing, and that way when I make the next video, you will get a notification. Hope you enjoyed it, and I look forward to seeing you in the next video.